Reserve is the reason. The chair of the Federal Reserve is arguably the most powerful person handling our economy, but interviews with the head of the Fed are rare. Chairman Jerome Powell was appointed to the Board of Governors by President Obama and was elevated last year to chairman by President Trump. Since then, the Fed has raised interest rates 4 times, leading Mr. Trump to call the Federal Reserve crazy. Last week at the Fed's headquarters in Washington,
we see the economy.
Alright guys, welcome back to MMGinvest and WolfPack Cryptos. In today's special video, I will be providing commentary and my thoughts and opinions on this interview, which was on 60 Minutes Sunday night on March 10th, 2019. For a split second, Janet Yellen and Ben Bernanke were on it, and they literally said maybe 2 words. But I will be talking about how this is more of a PR stunt than anything. So let's get into it.
As in a good place, we think that the outlook is a favorable one. Inflation is muted, and our policy rate we think is in an appropriate place. So what we've said is that we would be patient.
What does patient mean?
Patient means that we don't feel any hurry to change our interest rate policy. What's happened in the last 90 or so days is that we've seen increasing evidence of the global economy slowing down, although our own economy has continued to perform well.
Where do you see weakness in the U.S. economy?
Generally speaking, the U.S. economy is coming off a very strong year. Last year we had growth just a touch higher than 3%. We have high levels of employment, low levels of unemployment. Wages are moving up. Consumer confidence is high. Business confidence is high. We've seen a bit of a slowing, but I would say the principal risks to our economy now seem to be coming from slower growth in China and Europe, and also risk events such as Brexit.
All right, I just wanted to comment. So he said the largest risk is China, the European Union, and Brexit. Now, the Fed leads the way with interest rate policy globally, believe it or not, because there are currency wars. You have to understand that China and Europe, they have to do sort of what the Fed does because the export and import balance is way out of whack. And China wanted a weaker currency so they could sell Americans more goods. So revenues would be higher for their corporations, right? Now, also because the dollar is the world reserve currency. So whatever the Fed does, all the other central banks have to play along. If they don't, then their exports are going to get slaughtered because the U.S. consumer is 17% of the global GDP, meaning U.S. consumers make up 17% of the global economy because they buy so many goods.
A record 7 million Americans have fallen behind on their car payments. Never happened before. What do you make of that?
Car sales have been quite high for a number of years, so the whole body of outstanding auto loans is much larger than it was. I think it also, though, shows that not everyone is experiencing this widespread prosperity that we have, and that's something we pay attention to as well.
Retail sales declined in December at the fastest pace since 2009. Are these things taken together suggesting that the system is blinking red?
There's also evidence, by the way, that that spending has popped back up in January, but that's a surprisingly weak reading, and we'll be watching the next month's reading shortly.
But the overarching question is, are we headed to a recession?
I think growth this year will be slower than last year. Last year was the highest growth that we've experienced since the financial crisis, really in more than 10 years.
I just want to touch base. He did say that some have benefited more than others from this recent almost decade-long expansion period within the economy. And most people listening to this video are like, well, I didn't feel any expansion. I'm not doing that much better. And most people are actually doing worse. You have to understand, because the Fed bailed out the banks and they printed all this money through QE, what they did was they financed it with inflation. Well, they financed it through debt, which will create inflation. And who pays inflation? That's the 90 percentile and lower, from the poor class to the middle class, right? Now, who benefits mostly from easy money monetary policy and artificially low interest rates? Those are Wall Street, the bankers, and the people who are already super wealthy, and the CEOs and corporations, because that's where all of the wealth went. That's where all the money went. Now, the money they used to bail out the banks and all the QEs, the QE1, QE2, QE3, the money printing, that was supposed to go into the banks and be lent out to us peasants, right? To the bottom 90%, the middle class especially. But most of it wasn't lent out. Some was lent out. Of course, that's why we have a car bubble right now, because of easy loans for financing new cars and some mortgages for home loans. But a lot of it went into the stock market, and that's why we have we've just hit all-time highs just a few months ago on the stock market.
This year, I expect that growth will continue to be positive and continue to be at a healthy rate. You can break it down into a couple of things. One is, how fast is the labor force growing? And the other part is, how fast is productivity growing? The labor force, back when we used to have 4 and 5% growth years, the labor force was growing quickly, 2.5%, 3% in some cases, back in the 60s and 70s. We have an older population now, and our labor force is growing more slowly. It's growing less than 1% a year.
All right, so he's shifting blame, right? He said that our population in the United States it's old now, right? It's we have the baby boomers, they're retiring, but from statistically a population perspective, there's still more people now. There's a lot more people now than there were in the 60s, 70s, and 80s. So that doesn't hold true. We have the millennials are larger in population than the baby boomers. And I'm not sure about Gen X and prior to the millennials, but millennials now are in their late 20s, and some are in their early 30s as well. So they should be productive, and they should be taking on the economy and creating more businesses and innovating, and you have it.
So it's not likely that we could sustain the kinds of growth rates that we had when population and the labor force was growing more quickly. So for
all right, it was growing more quickly, but we still have more people being born than back then, if that makes sense. So in the 50s, yes, people were having more kids, but that doesn't mean that the population was growing in numbers larger than it is today. Today, because it's exponential, you have to understand that population growth is exponential, and we're still in the exponential phase of going up and up and up. Now, yes, in the Western world, Europe and the United States will taper off, and population growth will stall out, and there will be less. It'll stall out. The population will actually start shrinking, which is not a problem if your society is smart enough, IQ-wise, and has built technological advancements and machines and robots that will take over a lot of the, the smaller jobs, or the physical labor jobs, and the society as a whole becomes more technologically and even mechanically advanced, meaning they're more productive. Less people are more productive. That's a very strong economy. When a smaller population is more productive than a growing population or a large population. But yes, growing populations do boost economies because there's more people to work, and the cost of labor goes down, and there's just more people to sell things to, and more people make more things. But things are getting more complicated as we go into a new technological age of robots, 3D printing, AI, and you name it.
Percent is something we shouldn't expect in the future.
There will be years of 4% growth, but it would be challenging to see sustained 4% growth, again, because of the slow growth of the workforce.
The Fed is making a mistake. They're so tight. I think the Fed has gone crazy.
I don't think it would be appropriate for me to comment on other elected officials or on the president.
Isn't it your duty to respond when the president calls the Fed a much bigger problem than China?
My duty is one that Congress has given us, which is to use our tools to achieve maximum employment and stable prices, and to supervise and regulate banks so that they treat their customers fairly, and so that they're strong, well-capitalized, and can perform their critical function in good times and bad.
Let me unpack this, because I'm going to just destroy him right here. First of all, Trump knows if they keep raising interest rates, the Fed is going to prick its own bubble that it's been creating for many decades now, since Alan Greenspan really started it, and since Nixon took the dollar off the gold standard in 1971. But Trump knows if the Fed keeps raising interest rates, the economy is going to tank. We're going to go into a recession and a depression. Is it the right thing to do? Yes. Technically, like, Jerome Powell's not going to be Paul Volcker, and he's not going to raise interest rates up to 20%. Because if he does do that, this time around, the United States couldn't handle it like it could back in I think it was the late 70s and early 80s when Paul Volcker raised interest rates up to like 20%. Right now, interest rate, we can't even raise it to 3%. If we raise it to 3%, the entire stock market will crash and the economy will fall apart. And that's because of cheap money printing. That's what happens when your economy becomes credit-based, and it has to literally, the only way it can function is if it's functioning off of debt. Now, Trump knows this, and he's saying that the Fed is political because they wouldn't raise rates the last year of Obama or any of... They started raising rates. They raised rates once, and that was the last year of Obama's term. And then ever since then, they've raised it 4 times on Trump. And Trump is saying this isn't fair, it's political, because they're going to crash the economy, and then he's not going to get reelected. Basically, there's nothing that the Fed could do to save the economy. That's how bad things are. If they normalize interest rates, which is the interest rates on everything, right? On your car loans, home mortgages, and everything. If they normalize them, then everyone's going to default on all their debt, and then everything gets wiped out, the stock market and everything. Now, this technically is the right thing to do. It's going to happen either way. But what they're going to do, what's politically, let's say, the easiest thing to do for the politicians and Trump and for the Federal Reserve and for the banks and the big monopoly corporations that get all this free money, technically, the easiest route is to make the middle class and the poor pay for everything. And how do they do that? Well, instead of normalizing interest rates, they're going to lower them back down and then do more QE, and they're going to sacrifice the dollar, and it's going to cause inflation. And who pays for inflation? The average person does, and the poor person. And believe me, these companies and banks, what they will do is they will hedge their bets against a stagflationary economy. And we've seen a perfect example of that in Japan, where the economy really hasn't grown in like 20 years. but it hasn't fully imploded either. But Japan's kind of been in a depression for like 2 decades now. So it's called the lost decades. And what else did he say here? He also said that, let's rewind for a second. It was important.
Is one that Congress has given us, which is to use our tools to achieve maximum employment and stable prices, and to supervise and regulate banks so that they treat their customers fairly, and so that they're strong, well-capitalized. And
all right, so for one, their mandate is stable prices, and they've already failed at that. I mean, if you measure the core CPI and all that, according to their statistics, it's only been around 2% or a little bit less, and their target's 2%. I don't know why, but if you measure it from the old way they used to measure back in the 80s, it's running like 4 or 5%. That's like taking a haircut of 5% deduction from your paycheck every year, year over year, compounding, and that's why the cost of living keeps going higher. Maybe not your electronics like TVs and computers and phones, things you don't really need. Those aren't really going higher because of technological advances, and it just makes it cheaper to produce these things. But things that you do need, like health insurance, food, energy, gasoline, things like that, those are going to keep going up eventually. Well, not eventually. They already are. The groceries have been going up. There's the Thanksgiving barometer for inflation. How much did it cost to buy the same things every Thanksgiving? It's been going up for like over a decade now. Anyways, what else did he say? Oh, and another thing that they are responsible for, and that is to make sure that the banks are well capitalized so they don't go under. First of all, that's not free market. That's not capitalism. If a bank is giving out bad loans, if it's doing fraudulent things, if it's over leveraged, yes, it should go under. And that's why we only have like 5 banks or 6 banks in the United States. I know there's more, but really, like 99% of Americans' money is in like 5 banks. There's no free market, guys. That's monopolies, all right? And the Fed is owned by these banks. That's what nobody likes to talk about. And that's why his mandate is to keep these banks afloat, because everyone on the committee is actually elected not by just the president, but by the bankers like J.P. Morgan, Citi, Bank of America, and all of them. All right, so you guys have to understand that. And the funny thing is, real quick, let me show you. Fed votes not to impose capital buffer on banks. Published March 7th, 2019. Today is March 10th. 3 days ago. And he did this interview, I think, 2 days ago, maybe 3 days ago. The day after, but it doesn't matter. They voted on this. Fed votes not to impose capital buffer. Meaning they voted not to force the banks to have a larger pool of cash and capital as a buffer in case things go wrong. I mean, this blows my mind. Are they seriously this stupid? We are coming up on the largest economic expansion in history, and you think there's not going to be a correction coming soon? Anyways, I will post this article in the below this video in the comments section. Let's get back to this interview. It gets better, guys.
Perform their critical function in good times and bad. That's my.
How independent is the Fed? Who do you answer to?
We are directed to execute policy in a strictly non-political way, serving all Americans, and that's what we do.
All right, they're definitely political. They always have been. First of all, every president wants the Fed to lower interest rates. That's another reason why we're in this mess. And that is because whenever they tighten or normalize interest rates, we go through a recession. Well, whoever's in charge at the time, whatever party or president, they don't want that on their watch because they're not going to get reelected. So they're always incentivized to do the wrong thing, and that is to just print more money and blow up bubbles. And that's why we are here today. And it's also, I have a theory where it's easy for the government to tax large corporations and banks than it is to tax the public and the majority, the masses. Because the more the masses get taxed, they're less likely to vote for more free stuff and free promises that politicians promise, so they get reelected. And that's why the Fed prints, and it goes into the stock market, and then it flows to government. Technically, it flows to government first, but I'm not gonna get into that.
We are independent in that sense. Our decisions on rates can't be reversed by any other part of government. Our accountability runs through the elected representatives and the oversight committees in Congress.
Public, Congress, business, the president.
Well, I kept on my desk a quotation from Abraham Lincoln to the effect that if you're right, it won't matter what they say. If you're wrong, it won't matter what they say. So the best thing to do is to make what you believe is the right call.
That was Ben Bernanke. And, I mean, he's... Out of Alan Greenspan and Janet Yellen and Jerome Powell, you know, you could at least say Janet Yellen and Jerome Powell have inherited Ben Bernanke's mistake. And Ben Bernanke also inherited Alan Greenspan's mistake. But Ben Bernanke came out and he bailed out all the banks and just printed trillions upon trillions. And you have to understand fractional reserve lending. There might be like 4 trillion on the balance sheet, but that's, you know, with fractional reserve lending and all the derivatives, it really equates to like, I don't know, maybe hundreds of trillions, a quadrillion. There's been studies done on this. I'll talk about that in other videos.
To maintain inflation at 2%, about where it is now. But Powell told us he's flexible to a point.
If the inflation rate rises something over 2% for a limited period of time, that doesn't mean the Fed's going to jump on the brakes.
I think we wouldn't overreact to inflation modestly above 2% any more than we overreacted to inflation modestly below 2%. I think we'll always be moving inflation back to 2% with our policy, but I think we'd do that in a symmetric way.
All right, so basically he's just prepping the markets and he's telling them, don't worry, I have your back, and this helps the stock market go up higher because it's due for a correction. And inflation above 2% for them is really, it means we're about to have, in the real world, 8% inflation. And you know, one of the main mandates of the Fed is stable prices. Well, letting inflation just get a little higher, you're not going to be able to stop it eventually. And that's when you start getting runaway inflation. Then you start ending up like Zimbabwe, Weimar Germany, or Venezuela, right?
It's taken nearly a decade to worry about inflation again. The collapse in the 2008 financial crisis was the worst since the Great Depression. Mortgage fraud on a massive scale caused the Dow to fall 54% and unemployment to rise to 10%. Taxpayers were forced to bail out reckless Wall Street excess. Back then, tighter restrictions were imposed on banks, but now Powell and Congress are loosening those rules.
Are American banks...
So that they're setting up the public. You have to understand. By the way, this interviewer and all of this, it was only like 8 minutes of content. The questions he's asking are perfect. This is all scripted. And it's to set up Trump and the conservatives, because they just said, well, they just loosened regulations. Yeah, not regulations on home mortgages or anything like that. By the way, during the late 90s, right, Glass-Steagall was repealed by Bill Clinton, and that's what actually caused the housing bubble, along with Alan Greenspan and George W. Bush, making mandates and forcing banks to give out loans to people who couldn't afford homes. And it created that massive housing bubble. So it's not the free market. It's like they're trying to pivot and blame less regulations on the free market, when in reality it's socialism or fascism. It's literally the banks and government and the central bank, right, that have created all of this. Because in a free market, you would never have bubbles even remotely this close, or this close to this enormous size that the world's never seen before.
Safe today.
The American banking system is much, much stronger and more resilient than it was before the financial crisis. Particularly the largest banks have double or more the amount of capital, which is to say resources, to absorb losses. In addition, we've required them to undergo resolution planning in case they do fail. There's a plan for what to do, which doesn't involve a taxpayer bailout.
But in 2007, the Fed missed the reckless, criminal banking that was happening. How do you know today that the banks are safe?
We spent 10 years analyzing, understanding what went wrong, and trying to correct it.
A collapse of...
No, it's because they are the bankers. It's because you're talking to you're talking to them, literally. I mean, the Fed is made up of all these banks. It's hilarious.
The financial system, like we saw in 2008, cannot happen again?
Cannot is a strong statement. I would say that our system is vastly more resilient.
How concerned are you about either criminals or, more importantly, hostile nations attacking our banking system through the computer system?
We divulge. I would say for cyber risk, though, I've never felt a time when I think we're doing enough.
I have the sense that I just hit on the thing that keeps you up at night.
I would say of the risks that we face, that certainly is the largest one.
It's become your top priority.
The kinds of risks that we faced in the financial crisis are very real, but we know, I think, generally what to do there. Cyber is a relatively new kind of a risk with nation-state actors, and it's one where the playbook is still being developed in real time.
Right, don't blame us for creating a bubble. It's definitely going to be some cyber attack, some made-up event or something. And people will believe it, too. People will believe it. Because people don't understand what's going on. That's why I'm here making videos.
Powell told us about another risk hidden in our economy. It includes an estimated 500,000 workers who've given up looking for jobs.
And we have an unusually large number of people in their prime working years who are not in the labor force. The United States has a lower labor force participation rate than almost every other advanced country. That is not our self-image as a country.
Where did these people go who are no longer looking for work?
Part of it is evolving technology. So as technology
they're on the dole, they're on welfare.
Evolves, it requires rising skills on the part of the people. U.S. educational attainment has not moved up as rapidly as it has in other countries.
Well, that's a lie. There's a reason why college is so expensive. It's because everyone's guaranteed free grants to go to college. And anyone who wants to go to college could go to college. It's like the easiest thing you could do. And then they just wrap debt around you. The problem is that the educational system is broken and these kids aren't being taught free markets, entrepreneurship. They're just being taught how to go to work for a mega corporation that's not going to really need them in the future anyways because of algorithms and robots. But besides that, they're being taught socialism.
Globalization is also a factor. For many advanced economies, manufacturing, to some extent, has moved into developing countries. So, for whatever reason, and the opioid...
I agree with that. The United States has been gutted from its industrial base, and that's what made the United States the richest country in the world. It was the Industrial Revolution, nothing else, and freedom. It's freedom and industrial revolution. And do we have those today? I don't think so.
The opioid crisis is related to, I think, to those other factors.
The opioid crisis.
The opioid crisis is millions of people. They tend to be young males. It's a very significant problem, and it's part of a larger picture.
I mean, you seem to be talking about part of this generation being lost.
That is the issue. When you have people who are not taking part in the economic life of the country in a meaningful way, who don't have the skills and aptitudes to play a role, or who are not doing so because they're addicted to drugs or in jail, then in a sense they are being left behind.
Right, and guess what? I mean, he just did the blame game again. He shifted the blame to drugs, not himself, not the Fed. It's drugs. Let's go down the list, guys. Global slowdown, China, the European Union, Brexit, demographics, the elderly, the baby boomers are getting too old. There's too many old people, which is it's a part of it. I'm not saying it's not, but I'm saying it's not going to be the main factor to why we're going to have the biggest recession, depression the world's ever seen. Productivity, it's slowing. Well, yeah, it's because of endless money printing and debt, and the educational system's broken. The trade war, it's going to get blamed on that as well. Deregulations, blame the free market, of course, because, you know, central banks, they are exact opposite of free markets. They are central banks, and they try to manipulate the free market, right, with their interest rates and their money printing. Cyber hacks, of course, you know, that's like the best thing that could ever happen to these bankers, is someone actually came and attacked Wall Street. But, you know, that could be an inside thing. Worst participation rate ever? Well, of course. I mean, the educational system, everything is broken because it's not ran by the free markets, ran by central planners or government. And drugs. Yeah, there's a lot of people on drugs, probably because they can't make any money, because there's no industrial jobs, and the nation's been gutted because, well, the U.S. isn't competitive on a global stage because of high taxes and high regulations. And, yeah, millennials. I mean, that's their parents' fault, and the educational system and the nation as a whole. And if you guys found this video informative, smash that like. Also, please share my videos. It's the only way it gets around. And leave in the comment section what you guys think. I will answer your questions as well. And check out all the links below if you're interested in gold, silver, mining stocks, or interested in cryptos. I have 2 websites. We do research. And there's free chat rooms you guys could join. Until next time.